Have you ever wondered how a private equity buyout can yield high investment returns? Well, let's demystify that. A private equity buyout is a financial transaction where a company is purchased, not by another company, but by a private equity firm. These firms pool together funds from various investors to acquire a controlling interest in a company. Now, what makes it attractive for investors? High potential returns. Private equity buyouts can deliver substantial returns on investment, often outperforming other types of investment. But with great reward comes great risk. These investments can be volatile, and there's always a chance that the company being bought out may not perform as expected. One strategy private equity firms use to expedite returns is the leveraged buyout, where they use a mix of their own funds and borrowed money to buy a company. This increases the potential for high returns, but also amplifies the risk if things go south. Now let's dive into some real-life examples of successful private equity buyouts. Blackstone Group's buyout of Hilton Hotels in 2007 was a landmark in the history of private equity. The deal was an audacious gamble, with the private equity firm shelling out a staggering $26 billion to acquire the global hospitality giant. It was one of the largest leveraged buyouts at the time, coming right before the financial crisis hit. But what made this deal a true standout was not just its size, but the strategic moves Blackstone made post-acquisition. Blackstone focused on transforming Hilton from a property-centric business to a fee-based, asset-light model. This included an aggressive expansion strategy, adding over 1,000 hotels to Hilton's portfolio, and launching new brands to cater to a wider range of customers. And the results? Nothing short of spectacular. When the Blackstone Group finally decided to exit, they did so at a valuation of nearly twice their initial investment. The total profit was estimated to be in the ballpark of $12 billion, making it one of the most successful private equity deals of all time. The annualized return on this investment? A tidy 14%, which is quite the achievement in any investment circle. But the impact of this deal went far beyond the financials. It revolutionized the hotel industry, setting a new benchmark for hotel management and franchising strategies. This buyout not only proved to be a financial success, but also transformed the hospitality industry. Another example of a successful private equity buyout is the acquisition of PetSmart by BC Partners. Let's delve into the details of this purchase. In the year 2014, BC Partners took the plunge and purchased PetSmart for a whopping $8.7 billion, making it the largest private equity acquisition in the retail industry at the time. The initial investment was substantial, yes, but BC Partners had a plan. The strategy was twofold. First and foremost, BC Partners accelerated PetSmart's growth by expanding its online presence, a crucial move in the digital age. They acquired Chewy.com, an online pet retailer, which boosted PetSmart's digital sales exponentially. Secondly, they improved in-store experiences, optimizing the layout and expanding services to include grooming and veterinary care. Now let's talk about the payoff. After implementing these strategies, PetSmart's value skyrocketed. When BC Partners sold the majority of their stake in Chewy.com in 2020, they raked in an impressive return. The final sale price? A cool $11 billion. This translates to an annualized return of approximately 13%. Quite an impressive figure, considering the average annualized return for the S&P 500 over the same period was just under 8%. The PetSmart buyout is a prime example of how private equity can revitalize a company and generate substantial returns. This case illustrates the power of private equity and its potential to transform companies and yield high returns. These case studies demonstrate the potential of private equity buyouts to deliver high returns. Let's recap. Private equity buyouts involve acquiring a company, often with the goal of improving its performance and selling it for a profit. They can deliver high investment returns thanks to a few key factors. Firstly, the buyout process often involves implementing a strong investment strategy. This could mean restructuring the company, implementing cost-cutting measures, or leveraging the company's existing strengths to increase its market share. Secondly, the potential for high annualized returns is significant. Some private equity buyouts have seen annualized returns in the double digits, a rate of return that's hard to match in other investment sectors. But remember, private equity buyouts aren't without their risks. They require a significant upfront investment, and there's always the risk that the acquired company may not perform as expected. While private equity buyouts come with their risks, The potential for high investment returns makes them an attractive strategy for many investors.